Q's 630 by end of week. You know, yeah, that would be the magnitude. The only thing is you just got to be aware, like, when we talk about big targets, we want big evidence too. The month is still red. So overnight, you have the week green. So this week overnight, you know, you got the buyers there. This month overnight, you got the sellers here. It's just these sellers on the month are not here right now as far as we know this week. So we'd expect this week, you know, the buyers are more aggressive. So they should be trying to go higher. But if we go to like IWM, this was the better one today because you're going to see it was already green on the day, the week, the month. It's like it was going up this week. IWM didn't even take last week's lows. So when you look at it, this inside 60 in IWM, very powerful because when that broke, the day, the week, the month, everything is green. So that would be preferred. Now, hey everybody, thank you for joining the YouTube stream. We're going to discuss some more shortly. But going into end of day, you know, we're buying it. That's the ideal scenario. So looking at the 3 on the outside 15 IWM, you're going to have the Rev Strat 30 kicking in right now. Q's may have a 15 or reversal. SPY may have a 15 or reversal. There's just a lot of inside 60s. So, you know, they just opened up 10 minutes ago. But give me a short minute. I'll be back. Give me like 2 or 3 minutes, and then we're going to get started, and we're going to talk about how to know where price is trying to go at all times. And there's one thing that I want to discuss that every trader that I see losing with the strat gets 100% wrong. So hopefully that's not you, but if it is, we have the solution. Just give me a few minutes, and we'll get started. All right. I'm gonna sit down at my desk, so just give me a sec. Why are fair value gaps a lie? Well, let's discuss that first. So why are fair value gaps not true? It's because what you're not going to see with a fair value gap is you're not going to see that same thing on a higher time frame. So, for example, if I look at IWM on a 15-minute, this is a 3. I know for certain that's a broadening formation every time. This is your broadening formation right there. New lows, new highs. So this is what we're looking for because this allows us to gauge where price is going to go. Looking for the 3s and knowing 3s occur. Fair value gaps will directly conflict with what we know about those. So for example, this is a 3. This is a broadening formation on a lower time frame. So it goes up, comes back in below this. This fair value gap tells us nothing, right? In fact, what it tells us is these guys are long and we're going back through them. So that's a problem for these guys who are long. Now, does that mean price has to take this other side of the range? No. But what price tends to do is take both sides. So regardless of is there a fair value gap or not, has nothing to do with how price is moving. So let me just go to XRP and show you on like a monthly basis. Look at this. So when we look at this, we may not see a 3 unless we go to like a 4 month. Let's see. Yeah, so we're not going to see a 3 here. What we will see is compound 3. So notice this. New lows. So see how this bar's low here, this green one, lower than the previous low. And then new highs. This bar's high here is higher than this previous high. This is a 3. It's just 6 months instead of 3 months. So this is a 3. And that matters because you'll note, if we go to a weekly time frame, we know since broadening formations occur, once it's made this high, it does not matter that there's fair value gaps or whatever you want to call it, support, key levels, right? None of that really matters at that point. What matters is, are they selling or are they buying? Because what you'll notice is anytime this is red, they're trying to go down here. Anytime the week is red. So if it's red, watch, boom. Fair value gap, didn't matter, right? It was red on the week here. It's going to go through that. Take them out. So it's not true because it's a pattern, you know, in the sense of you're using 3 bars to identify this. And every pattern is identified by 1 bar. There is no, you know, let's go here. These are the only 3 things price will do. And fair value gap, technically it's something price does, but it really doesn't give us any additional information outside of the 3 things price does. There's no scenario 4, there's no scenario 0. So really doesn't matter to us. Especially because this fair value gap on the week, you go to a monthly chart, it does exist there, right? We go to a quarter, does not exist on the quarter. So that fair value gap doesn't exist. On a quarterly basis, has nothing to do with what price is doing. The only thing that mattered was that this was red at 285.96, which caused it to drop 35%. A 3 can expand also. Yes. In fact, that's something we look for because if we go to SPX, we can go back to the beginning of time and we can see exactly what price has done as it pertains to the broadening formations. We're going to start with a yearly chart actually, but you're going to see what price did. Broadening formation, right? Then it made the new lows, broadening formation. Then it made the new highs, broadening formation. Then it goes inside of this broadening formation, which restarts the broadening formation right here. New lows, new highs, and then it expands, right? That's something we look for. And then you'll see top of the range again. And this is going back to, 1900. So this is before algorithms existed, which also refutes ICT. It refutes his initial claim that he invented the algorithm because this is how prices worked since ever, right? He was not born in 1872. Therefore, the price has been doing this well before any of those concepts were created. And when you base your universal truths of price, whatever you subscribe to, if you base it on what someone else thinks instead of what's actually true, is not useful to you, right? None of these fair value gaps were useful if we go back, right? If you turn a fair value gap indicator on, none of this mattered. None of it mattered. We made a new low here, that mattered, right? And then they started coming back through. This fair value gap did not matter, right? So it has nothing to do with that stuff. It has everything to do with broadening formations and all the different ways price can reverse because there's only so many. So this is all price will ever do on one chart. It shows you everything price will do. I think the only thing we don't have is 3-2 continuation on here, but it looks just like a 3-2 reversal. It's just green, green instead of red, green, or red, red instead of green, red. So hopefully that helps you out, but you want to base it on what's true, right? That's always the question you should ask whenever you do anything. Like I want to be a very good golfer. So my question is, what can I know to be true about a golf swing and like how to play golf? The mental side of it, like all of this stuff, right? What do I know to be true about it? It's not, what did Bryson DeChambeau say? He probably says a lot of things that are true, and he does. But what can I know to be true for sure outside of opinion? That's what matters. Stopping people out? Not quite. That's something that happens due to price discovery, but that's not why it happens. we'll discuss though. So let's define our terms because, and I'm going to actually turn the, where is it? Yeah, I'll turn this on. Let me get the, oh, that was bright. All right. I look kind of red. I guess this will work. All right. A little less red. So first we need to define our terms, and my camera's up there. So the first thing is the three scenarios, right? And it's the first universal truth of how price works. Price only does three things, and this applies to all time frames. And this refutes pattern trading. It refutes moving averages, EMAs, SMAs, support and resistance, you know, at least in the traditional technical sense, supply and demand, all of it. Because price is either going sideways, trending up or trending down, or rejecting a trend, going the other way. It's only three things that can happen. So we have scenario 1, scenario 2 up or 2 down, and scenario 3. And this one right here is the most important. You'll notice it's an outside bar, which means that this green bar is outside of the previous bar's range, making new highs and new lows. So it takes both sides. And the only way a 3 happens is if it's a 2 first, which means this. It opened like this, and then 3. So when it opened and it was green, anytime it was green here, we had a target. It's going to try and take this high out. The same way here, new highs, it goes red. Anytime it's red below that open, we have a target to take the other side of the range out. So when we go to the reversals, just keep that in mind. You're going to notice we are always looking to fail one side of the range as a level of reclaim. So it makes new highs and then comes back in. You may wonder, it's like, Alex, is this not a resistance level? Well, the main premise of support and resistance is you have a high. Let's say it's at like $100.01. The premise is at that high, there's resting sell orders because it goes to 100. And then if it's resistance, it's going to go lower because there's resting sell orders. But that's not true because when you get to 100, like let's say price was trading at 50 and then 60, 70, 80, 90, right? You get to 100. Do you think everyone has a sell order at 101 penny, like a penny above it? Or do you think it makes more sense that everyone that was short from 100 to $50, when we break that 100 level, those shorts have to get out. And you also have breakout traders that are trying to buy this level, right? So you have buyers that are still buying. You have shorts that are forced to get out because every short position from 100 to $50, once you're back above 100, they're underwater. Like they really have to get out at that point. So you have everyone buying, right? There's no resting sell order. That doesn't make any sense. So this is not support and resistance. What this is showing is we take this level out, there's buying going on above this level, and then it gets rejected once it starts coming back in. And since we know outside bars happen and they look like this, right? Outside bar. If it happens in more than one bar, it's simply a compound bar, right? So it makes new highs, signal, target. And that's what we like to do both ways. And this is going to apply to most reversals besides the inside bar. So you'll see the 3, 2, 2. So outside bar, and then it ticks down and it goes outside again, right? In 2 bars instead of 1, like this. We can also see 3, 3, 3, 3, like over and over. So it can happen in 1 bar. It can happen in 100 bars. What matters is that it happens, and it allows us to gauge how far price is trying to go. And you'll see pretty much every single one, right? We have a level of reclaim. We have a target. Level of reclaim, target. And if we look in here, I don't have them marked out, but if we did want to mark them out, it would look like this. Level of reclaim here. Level of reclaim here. So you can see it reclaims a level and then we get a target. And then in between there is when we get our signals. So everything's going to look like that besides inside bars, because inside bars are consolidation breakouts. So you have consolidation, breakout, then a target gets hit. And this target is also a level of reclaim. So you can see here, outside bar here creates the level of reclaim. Then the inside bar triggers that level. And then what matters is, does it stay there or does it start ripping back through? So if we go to, let's just find an example of where we have an inside bar, right? Right here. So this is in 1939. But you're going to see the inside bar. Inside bar, it breaks down, hitting the level of reclaim. And then what? Price reclaims the level, which gives us what? A target to the other level, or the other side of the range, which is up here. So that's a 42% move in a couple of years back in 1942. Okay. So this can happen, you know, from the levels of reclaim like this. We can also see it happen just in, you know, just like this, right? Goes new highs, comes back in, makes new lows, and then level of reclaim. So price is always doing what we call price discovery. And what that means is this. What price will do, and if you've ever seen, you know, any of these charts like the market maker buy model or Wyckoff or whatever it is, they're all trying to show price discovery. They just don't have it defined in the best terms. Price discovery is this. Price will constantly test both sides of the range, because what's happening is when you're above this, this is relatively expensive compared to what it was before. When you're below this, it's relatively cheap compared to what it was before. So what happens is it goes into the new highs. The sellers start stepping in. They're like, yeah, this is too expensive. They sell. When that happens, you have buyers in this whole range, right? Every penny, there could be a stop loss order in there. Doesn't matter that there's stops. But what it does tell us is, as we go back through all of these stop loss orders, price will speed up. So if you've ever seen something like SPY today, and this is why we don't like trading at all-time highs, but if you've ever seen something like SPY today, goes 2 down, 2 up reversal right there, boom, and then you'll see the new highs. So what happened? What happened, right? There's the 2-2 reversal here. The sellers sold down. 2-2 reversal at the open. The buyers buy it up. So the sellers sold down. The buyers buy it up. As we go back through this range, we're stopping out people who are short. And we have a buyer that's buying. So everyone's buying. The shorts are buying. The longs are buying. Everyone's buying. It's going to go up very fast. You can see it took 4 or 5 hours to get down here. 2 hours to get back up. And then they did that whole range again. 2-2 reversal below this, $4 target in 1 hour. So it went 5 hours, 2 hours, 1 hour. Then you'll see inside bar, 1 hour, the whole range again. So what are they doing? They bought, they stopped those guys out, and then the buyer came back and all the shorts had to get out. So what we're constantly doing is we're auctioning the price. We're showing it at a higher price and a lower price. And what matters is, you know, do the buyers show up or do the sellers keep selling? You know, or do the sellers show up or do the buyers keep buying? So at all points, what you're going to see price do is it'll make new highs, right? And then in this case, the sellers show up, gap down, then the buyers show back up, right? They make new highs again. Here, the sellers show up. The buyers tried to buy it. Not quite enough though. The sellers come back. The buyers tried to buy it, didn't change anything. Brings them all the way back down, and you'll see this. Then they make some new lows here. And then the buyers come back. Goes all the way back up. And you'll see we make new highs here, and then the sellers come back. And it is kind of a mess in here, right? And this is consolidation, but you'll see, then they gap it down. The buyers tried to buy it. The sellers come here. Boom, all the buyers are gone. And if we look left, you can see we've taken out pivot lows, right? So it comes down and then it opens back above, boom, new highs. And then it rejects, boom, new low of day. Then it rejects new low of day, boom, new high of day. And you can see the shorts that shorted this morning and did not close, they were blown out of their short position. So how do we then time this, right? If we know price if we know price is going like this all the time, how do we time this? That's the big question. So it looks like this. If we simplify it down, sorry. This move from here all the way up to here looks like this on a bigger time frame. This is how we time it. When it goes green here, we know it's trying to go there. So we use multiple time frame analysis. So for example, if we go to SPY, since it's been volatile, if we go to the VIX, the VIX is at 19, finally 20. So we're seeing like a day, a day's worth of movement every hour. So we call this, or Rob would call this, compartmentalization, which is a fancy word for saying, if last year, or let's say last month, every day moved like plus or minus $4, if you're moving now $4 every hour, each 60 minutes is a whole trading day to you, because in 60 minutes, you can make as much as you would have made in one day last month because volatility has increased. And that's where you can see, right? Like you can buy it in the morning, sell it in the later morning session, come back in the afternoon, buy it again, right? And it's going both ways. And then you could have even sold it up here, right? And made some money on the way down. So it's very fast in both directions. Now, since it's faster, we use shorter term timeframes. So if we go in here, you're gonna see we have the 60-day, week, and then the month. This would be our standard continuity. And the reason we do this, all this shows is the color of the timeframes. But the reason we do this is because when we see them all align, so the 60, notice the 60 is green anytime the day is green at the beginning of the trading day. And then right here, the week goes green, right? This was the week open. At that point, as long as the 60 is green, what it's telling you is this: the buyers in this market are more aggressive. Price must be going higher on a 60-day and week basis. And then each 5 minutes, every 5-minute bar that's green, right? That buyer's there right then and there. So you can see they buy them all the way up. And then at yesterday's highs, there's profit taking. Then right here at 11:30, when the new 60-minute bar opened, the 60-minute seller, the weekly seller eventually came back, but the 60-minute seller comes in here and starts selling. What does that do? You can see it changes the week to red at 11:40, and the month is red. So this month, this week, and right now, the seller is more aggressive. So where's it going? Ideally, low of day, and then ideally would have been outside day. But you'll see, right, they sold it all the way down. There's some profit taking, and that was it. Because we made the new low, and you'll see we just stayed above it. So we reclaimed that low. So if we know the broadening formation occurs, we have low, new high, new low, and we're coming back above it. Where would it go? It's like, well, it goes ding, ding, ding. Now, how do you time that though? You have to time it with the 60. In this case, you're going to see this new broadening formation starts in here. But if we go to a 60-minute, the inside 60-minute actionable signal on SPY. Why is this an actionable signal? Because what this shows us is buyers and sellers agreed. SPY drops to the daily open and they agree. They're like, yep, prices are worth this much. And that matters because if we go to just, a little bit of basic stuff. If you've never looked into game theory, I highly suggest doing so. I'm actually going to be buying a few books myself on it. But explain equilibrium in terms of game theory and markets at a, let's just say, a 9th grade level. Something, it's going to be clear enough. So, equilibrium in markets is about prices, right? In our case, market equilibrium happens at the price where the amount of consumers who want to buy is equal to the amount of producers who want to sell, right? And this is in specifically markets, not in like stock markets. Stocks are slightly different. It has to do with how aggressive the buyer or seller is. But when we look at game theory, each player has to choose a strategy. So you have to think, each person going in and trading SPY today, they have to do something. They have to choose their strategy, okay? To try and get the best result. An equilibrium, or Nash equilibrium, happens when every player's strategy is the best they can do given what the others are doing. So no player can do better by changing their choice alone. And when we look at this, the inside bar, what this is showing us, they agree on prices, which means, no one's winning and no one's losing. This is the best everyone can do, is just be flat, right? Nothing's happening. So if everyone's just doing nothing, which means 70% of the market traded by algorithms, that means those 70%, of market volume, the algorithms, they're doing nothing. Once that closes, they might be done doing nothing, because the algorithms have to be told when are they going to buy and when are they going to sell. And that's why we use this 60-minute open, because it opens here, it's green, they're buying. Green, they're buying. Red, they're selling. Green, they're buying, but it's going sideways. Then you'll see 1330. It opens, it was inside, and then it broke green. So what does that tell us? Sell, equilibrium, they agree on price. No one's doing anything. Right here, the algorithms were turned on to buy. How much evidence do we have? At the time of the break. So you're gonna see at the time of this break, might take a few minutes to get up here. All right, pause. So at the time of this break, if the 60 is green, we have the 60-minute and the day. We would also note the weekly open is right here. So if the 60 works, since we have a magnitude to hit our levels of reclaim, as we'll call it, but it's the highs of the mother bar, it's our magnitude or our target. If the 60 is green, the algorithms and everyone else is buying. So anytime that was green, boom, it's going there. How much evidence? The 60, the day, and the week above this level at 68149. So when the 60 is green and the day is green and the week's green, what does that tell us? Whoever was selling on the month is not selling right now. They're not selling today and they're not selling this week. So what do those guys have to do? They're going to have to buy because, if you sold back in here, you got to cover your short position. So when we take high of day out, that's what happens. Short positions get covered. Boom, right? Way into the highs. Look at that. Do you see how fast they're closing those short positions? That's what's happening. So the inside 60 actionable signal times the movement, giving you a target. And then notice the month goes green. So if this would have stayed green, we would have had full evidence back to all-time highs. But at this point, the month opens right here. So they're still battling around this as we get towards the end of the day, which 307, 308. You can see inside bar. So for tomorrow, this is one of your equilibriums, right? Buyers and sellers agree on price. So the question is, do the buyers come by and get more? Or do the sellers try and go drop back in below these previous highs to target the new lows? And since the month open is right here and the week opens right here and the day and 60-minute open tomorrow morning, we have no idea, right? There's not really much bias here. It's just both ways until we get long red bars. Say the buyers leave at that level. The buyers leave at that level. I don't know if I use that terminology specifically. What we would say is like the buyers so if the 60 minutes red, right? It doesn't matter. Let me show you. So we're going to use all the time frame continuities we have. So the month, we're going to add the quarter, and we're going to add the year. And this is why most traders, they don't do very well if they don't understand continuity. So look at this. At the point of this bar here on Tuesday, we have zero evidence to say price is going lower. At 10:30 on the dot, it goes red on the 60-minute. At that point, whatever buyer that was present is not present for 60 minutes. The whole 60. Then, right here, 11:30, the new 60 opens, it goes 40 cents lower, and then the buyer's back. And then the buyer comes back and they're still here. Buyer comes back, they're still here. So you can see that 60 mattered because you'll notice when we're coming off of all-time highs, more often than not, it's either the 60-minute or it's just the 60 and the day. So like right here, this 60-minute, it made all-time highs. And you'll see it made a very slight higher high. And actually, no, so equal highs. But made equal highs. You'll see it reclaims this level. When that happens, the 60 and day are red. That's a problem. Because at the point of this being true, below this open at 69551, so right there, at the point of that being true, we have no evidence of the monthly, quarterly, yearly, weekly buyer. Even though all those timeframes look really good, we have no evidence of the buyer if that 60 is red. So you can see for 60 minutes, they demolish everyone. Each 60 matters. This is what I'm trying to tell you. Because you can have Goldman Sachs and they're like, I need 1 billion shares of Lockheed Martin. But if they don't need them for an hour, Lockheed Martin could drop 10% and then they go to buy their shares and it's up 100% in an hour. So timing is very, very important. And this is why swing trading is more tricky, because each 60 matters, right? Now, to an extent, when volatility is lower, the 60 has less pull on what price is doing. Because when the VIX is really low, it's really just those like the monthly, quarterly, yearly investors, they're buying all-time highs and they just keep adding, right? You have like 401ks, hedge funds, the passive, like the actively managed, not actively managed, what is it called? Think like any fund in the world, I guess. It doesn't have to be specific, but any fund in the world, if you give them $10,000 this month, they have to go invest it. So if you have a good hedge fund or, you know, whatever type of fund, every month, if you have 1 million customers, you could be getting 50 million bucks a month. So what are you doing with that money? It's like you're just throwing it into the S&P, or you're throwing like something, right? Like Vanguard or whatever you're doing. You're just tossing it into the market. We call that passive inflows. So when you have these big time frames aligned, those passive inflows, those are up. Now, when they start changing, that's when volatility kicks in, because those inflows either stop or they're countered. So here, this was the beginning of November. This is the month open. Anytime the month is red, you can see the volatility really picks up, because this month, right? This quarter actually as well. Or no, here it is. This month, sorry. When price is trading here, this month is red. So this month we don't have evidence of the quarterly and yearly buyer on a monthly basis. Now, do we have evidence of the quarterly yearly buyer on a 60-minute basis right here? When it reverses at 66427. We posted this to Twitter, right? When that happened. Yes, we do. The 60 quarter year buyer shows up here at 66427. The break of that, here they go off the 2-2 reversal. Right, that's a pretty nice move. And then you'll see 60-day week buyer with the quarter and year. At that point, we didn't have any evidence of this monthly seller. And then it goes up. And then the 60-day month seller shows up again in here, very slightly. And then here, that seller takes hold. Boom. So you can see each 60, each day changes what's going on. And that's why you can see stuff like this. So if we just go to right here. Sadly, it's not going to let me. Maybe on a monthly basis. Yeah, it's not going to let me. But when this month opens right up at all-time highs, right? No one's going to say that's a bad-looking chart on a monthly basis. Right up at all-time highs. The month is going up, right? They've been going up. The week, right? They're just going, right? Each week, boom, they're buying. They're buying. Notice it's the yearly guy, quarterly guy, the monthly guy, the weekly guy. They're all buying this. Everyone's buying it. Now, when it opens gap up, you know, that's a good thing. Price is going higher. Yeah, but also when this is red on the day in 60 minute, that buyer's gone. Anytime that's red. So this morning, they gap up. Instantly they go red. Boom, that mattered. Down 14%. And that happens instantaneously at the open. I don't know if I can do 1 second. I can. So right at the open, see how that goes red, right? The 60 in the day. That matters. We have no evidence of these previous buyers as long as that's true. And you can see they get demolished. This is in like 10 seconds at the open, like, or 5 minutes at the open, right? Killed. That's 7%. So that does matter. And that's why days like today, where market's really moving, stratters will kill it because we can gauge control properly. Buy, sell, inside, do nothing, buy, maybe take some profit, but inside, do nothing. Yeah, I'll show you the intraday stuff now. So today on the stream, I was about to be in tears because I could not get my broker to fill my order. I was so pissed off. But we made sure everyone on the stream got in. I was begging people to take this. But you're gonna see 2. So we have 2 down, 2 up reversal. Now, this gap up, people will say, this is the gap up sell, Alex. Well, not true. Because if you actually paid attention on our Gapper educational materials, the first setup is a gap and go. We see this occur when we trade back through a previous range, meaning we want to have multiple pivot targets to trade back through. This is the same concept covered in the PMG section of the course. So what does it look like? Big range of red bars, right? All these pivots, it gaps up. That's a gap up buy through these guys. So what's today? If we go to like maybe a 5 minute, you might see this a little clearer. It's just like the example. What's today? Gap up, big range of pivots right here. This is your hammer actionable signal. This is how we'd get in. Right there. Boom. And our stop loss is 21 cents. It's the low of this bar. The break of that, the stop is here. So that would be in the morning, right? If you're just buying the open. Now, technically, anytime this is green above this, we had the day green and the 60 green. That's more than enough to take the trade. So you could have bought it with a tight stop. Maybe you stop out once or twice, and then eventually you get it. Boom. Make all your money back and then some. Then you will see we exhaust by price at 68477. We call this short-term exhaustion risk. So at short-term exhaustion risk, what matters is we have stopped out, right? These guys who are selling, they're gone. As far as we understand, because once price has taken it up here, you know, if you were short at 679, you're probably not short anymore. And if you are, you're in the minority, right? There's very few shorts that stuck around. Now, so once we've done that, it's up to the buyers. Are the buyers going to keep buying, or do the sellers come back and try to sell again? Because they obviously wanted to sell this thing. So we're back to the same price. Are they going to sell again? How do we time that? Well, we use the 30-60 minute intraday. So you're going to see here, the inside 30. And we're going to really dig deep here. Sorry. After an inside bar, there is only so many things that can happen. You're either going to become a 2 as a reversal to the downside like this, right? So price will either go inside and then go down with a target, or it will go inside and it'll break with a target to the upside as a continuation. Green, sideways, green versus green, sideways, red. That's how we know if it's reversal or continuation. So when we go to price, up, 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 inside. Either side of this inside bar actionable signal gets our attention because it's going to show us a new aggressive buyer or the same aggressive buyer coming back, or it's going to show us profit taking of these longs in the morning. The next 60-minute opened, traded 4 pennies higher. The algorithms were told, sell SPY, do it right now and do it aggressively by selling at the bid. Boom. This is the entry target, or entry. This is our target 1, target 2, target 3. Notice it's like the PMG. Inside signal, back through a range of pivots. You'll also see it's a range that has levels. We have the weekly open, the daily open. So we have multiple pivots and levels we're coming back through. That's a good thing. Boom. So we're pairing the 30 actionable signal with the 60, changing control to the seller. And not only can we take the 30-minute, we can say if this inside 30-minute works to the downside, what will it create, negate, or do? In the case of this, we go to a 60-minute, it would do what? It would trigger a 2 up, 2 down 60-minute, which has a magnitude of 678.97, the low of day. We understand this because price only reverses so many ways. The 2 up, 2 down reversal has a target. It's always this bar here. So big green bar and then reversal. This is always the target here. Big green bar, 2 up, 2 down reversal there. This is always the target. Now, targets are also levels of reclaim. So we can put, anytime you see target, it's also a level of reclaim, which is why it's the target. 2 up, 2 down is T-Trade's model. Yes, this was something T-Trade's learned back, 6 years ago when we taught him the strat. He was actually in our Discord for a long time until he started picking up steam with the 2-2 reversal. But this is why he uses it, because there's a level of reclaim, a signal, and a target built in. And that's why the strat works. So we get our 2 up, 2 down reversal. The target's met, which is also a level of reclaim. So either we're below that target and we get to hold, or we start coming back in and we have to reduce or exit. We form an inside bar. Again, inside bar. What is the next 2? What will it create, negate, or do? So we mark out our inside bar and we mark out our pivot levels here. So what we understand is if we're above this inside bar break, the week goes green, the day goes green, and the 60 is green. So anytime we're above that, that matters because we have a magnitude to take out. 68429 and then high of day at 68513. So we have a trigger, magnitude. The stops, ideally you're not stopping out at the low of this inside bar, but you can. I would prefer the tighter stop if you just use the open. You might enter, look at this. You might enter, lose 30 cents, enter, lose 30 cents, enter, make $5. I'm good with that. I'd rather do that than enter, lose $5, enter, lose $5, enter, make $5, right? You're still down. So I'd rather use a tight stop because I'll tell you this one went instantly. There was no hesitation and we could add to this twice with the 30 and the 60 signal here. When this broke, it was not instantaneous, but if you stop out and get back in, you're good. You can get a 3. Yes, you can. But we're just talking about today. I can show you the 3s in a second. So we have our inside bar reversal. We have our magnitudes, all of our good stuff, right? Now, with an inside bar, you can also, let me go to NNE. You can also have what we call Rev Strat, which is our favorite thing in the world. And it looks like this. So after an inside bar, if the 2 fails, so if you take a trade, and this is why we don't want wide stops. If you take a trade, so you have your inside bar level, and it breaks above it, and then starts coming the other way, you're in trouble. Because you can see, inside bar, what was the first move this thing made, right? It opened down here, went down, and then went green and failed as a 3 to the upside. So it went 2 down, went green, and then became a 3. So since we know this happens, after an inside bar, we call it Rev Strat because we have an equilibrium. We had an aggressive seller, right? Price gap down, and they sold it down more. So they're willing to sell on a gap down. That's really aggressive. Then when it goes green, that seller is now being countered by a buyer. Then boom, right? Now, since this is a 3, the 3 technically does not have a signal versus the 1, 2, 2. 1, level of reclaim, goes green here and then closes out. So instead of going outside bar and 1 bar, like this, right, it's taking 2 bars. So we have a signal and then we have the target, the other side of that range. So we like to have the 1, 2, 2 because we can easily scan for this. However, if we're going to play for the 1, 3 like this, we prefer to do it on a gap, and we will use the inside bar and the 2, 2 reversal to make it happen. So if we just turn these dang indicators off, this was the daily open. You do not have to trade the first 30 minutes. There is more than enough. You do not have to trade the first 30 minutes when you're learning. It's trickier because you can see just how aggressive this range is. It's very tricky when you're not good at this yet. But you'll see 1, 1, either side of this range gets our attention. 2 to the downside as a reversal. Green, green, red. And then 2, continuation, they're still selling. Notice they open here instantly. 2, they open here instantly, they're still selling. And this is the daily target, your level of reclaim. So we had level of reclaim at 3640. Then we had 32, which is target as well as level of reclaim. So what do? Inside, short, 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 2 down, inside, buy, 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 inside, inside, do nothing. So you shorted it here, flipped your position long here, and then you held it into the close, right? That would be, if you did this perfectly and you're swinging overnight. You don't have to swing overnight, but that's what it looks like. Now, if we go to XRP today, look at this one. So look at this 4-hour. You'll see it's 3. A 3 is a broadening formation. So when we draw this out, this bar is an outside bar to these 3. And you can think of it like the opposite of an inside bar. So this low, right? All of these bars lows here are higher than this low. This high, all of the highs in these 3 bars are lower than this high. So this is the range we went outside of. Then watch what happens. And this is why each bar matters, right? Every single one matters. Look at this. I think I played it too quick. Let it play second by second. UNH is a perfect example. Yeah, we'll pull it up in a second. You don't believe in inefficient in the market? This is what I don't believe. So I don't believe if I look at what someone did 10 years ago, like someone's like, oh, I want to buy Palantir at $195. And then 5 years later, we come back to 195. I don't think that guy is still there waiting to buy Palantir at 95. Like if he wanted to buy Palantir that bad, he would have just bought it at $220 and just been done with it. Like rarely are you going to have, like if you walk into a hedge fund or an institution that has billions of dollars like BlackRock or whatever, if you walk in there and you're like, hey, do you have any orders set for Bitcoin to buy it at like 5K? They'd be like, the fuck are you talking about? Like, it doesn't make any sense. And that's kind of the thesis behind the fair value gap. It's like, it was inefficient. There's orders here that need to be filled. Goes down, it fills the orders, and then it goes. So it doesn't make, it just doesn't make sense, right? What matters to the current price has nothing to do with what happened on this bar. What matters is what is the current bar doing? It's like right now, what it's showing us is they are selling this 4 hour. They are selling, and they're doing it aggressively by selling at the bid. Every time this gets redder, since people bought and algorithms bought the previous 4 hours, every tick lower causes more losing traders. So it should speed up as it goes back through the range. That's all we think. Because either they're selling right now or they're buying. If you're like, well, they bought 16 days ago at this price, it's like, well, that doesn't really matter to me. Are they buying right now at this price? Because if they're not, you're going to blow through your fair value gaps. Like, let me show you here. I'll pull it up. And I was well prepared, actually. I have a great example showing you how fair value gaps aren't really going to matter. But so this is what I said. The bullish fair value gap has nothing to do with future price movement, right? People will mark this out and they'll be like, that's a good thing. Nope. Because, and you can see, right? As they sell, these guys go into a further losing position, right? They just got to get out. That's what's happening here. But if we go back to the 4-day, do you really want a range that's 8% where you're trying to time a low in here? Not going to work. Where you should be timing it would be right there, 188.78. Anytime it's green here, then you can go after it. And that's it. Because if this is bright red on the 4-day, it could have easily just blown everyone out. It got another 20%. The problem with attempting to buy the exact tick bottom low and sell the perfectly this high, the problem is when you're wrong, your stops are so big, right? Like what will see traders do, and you can just go on, Twitter, they would go like this. So it's like, yeah, look I nailed this entry. It's like, well, this is not the best idea here. Now, if we're going to do that, if we want to time it, what we're looking for is exhaustion risk, right? People would say low resistance liquidity. That's what people would say. But right here, exhaustion risk, we've taken out all nearby pivots, which means we have no one else to trigger out of their short positions. Because if we're going to trigger more short traders, it's way up here, and we're nowhere near that when we take this out. So if we go in there, we can understand we're at exhaustion risk. And we can even get more specific on the daily here. And some people, they will mark out, previous reclaim levels, like up in here. But right there, 23393. So we're at exhaustion risk when that's taken out. We've taken out all these pivots as pivot machine gun. So if we mark all this out, do you see how all these pivots are in here? What is that going to do to price and why is the question. The PMG looks like this, right? A lot of pivots and then a signal. It's a cluster of previous highs and lows. When price breaks the first reversal, it causes all previous long or short traders to be forced to exit their position. So what this does is it removes liquidity from the aggressive buyer identified by the signal. So think of it this way. If there's only 10 Teslas on the lot and you get there and you want to buy all 10, when you start triggering pivots, it's like if you're sitting on the car lot trying to buy these Teslas and every pivot you hit is like 2 more guys that are jumping on the car lot and they're willing to pay more than you. So you're now in a bidding war. You have this aggressive buyer, which you can see the inside bar signal here above 187.89 with a stop of low a day at 0.64% lower. That inside bar signal, which was paired with the inside bar weak signal here as a rev strat, 1 bar rev strat. When that occurred, we identified an aggressive buyer showing up. This buyer showed up across all time frames, so we had full evidence on January 1st that the market was going up. We pair this aggressive buying with each pivot, and each pivot removes liquidity from the market. So price has to go faster when you go through all this stuff. It has to speed up. Because if everyone's buying and everyone that's short is buying, it has to go faster. You can see it takes how long? 48 days to get down here. It takes 5 days to go higher. So it's 1 to 10. It's 5 days back up, 48 days down. The pivots are what did that. Now you'll see once we take out all of them, is this a fair value gap? I don't know, right? But what we do know is we've taken out all nearby pivots, right? For sure, right there. So when this day goes red, at the point of the day being red, this shows us buyer exhaustion, right? They're taking profit. And then they come back and take more profit and more and more and more and more and more. So they just came back and they started selling it off. And then you'll see they made new lows. Didn't go anywhere. So what do? You have the mother bar. So you have two bars inside here. They make the new lows. This is Rev Strat. They make the new highs. Level of reclaim, right? Then they make the new lows again. Didn't really go anywhere. Inside bar signal breaks the lows, causes a huge move here. And then inside. Now what? They tried to sell it yesterday, tried to buy it today. They're just agreeing on prices. But how much evidence do we have if this breaks higher? So let's say in 2 hours it closes, right? Double inside bar. If it breaks up at the point of the break, we would change the weekly open more than likely, and we would have every single time frame green. So we would definitely have more evidence on the upside, albeit, it's only up 7% this year, so this buyer is not that aggressive. But that's what we see, right? The next two would be up. If it fails, we also know the Rev Strat can happen back to the downside. So we're ready for anything, right? We're ready both ways because price can always go 3 at any point. So why do you think an old all-time high before dip that was already taken, the price often bounces from a similar level? The April 2 dip was close to previous all-time high. Okay, wait. Can you rephrase the question? Or actually, there's a lot of question here. All right, let's see. So if we go back to XRP USD, why would we draw the broadening formation the way we did? We already explained, but the broadening formation is drawn objectively right to left. So that means this. When this goes 3, for certain that's a broadening formation. Unlike head and shoulders, cup and handle, fair value gap, blah, 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 blah. The broadening formation is or is not. It cannot become a not broadening formation. It is a broadening formation. That is its identity. Does not change. So 10 years later, this is still a broadening formation. That matters because we can see it happen in more than one bar, like this. We can also see this, where the broadening formation overtakes multiple bars. So one bar can overtake multiple. We can also have multiple bars, like 2 or more, that overtake one bar. But they're all broadening formations. This is a broadening formation. This is a broadening formation. This is a broadening formation. It's the opposite of an inside bar. So if we just draw this out, people would draw this and they'd say, this is a consolidation. And if you're an ICT guy, this is my accumulation area, right? And you just draw random lines. Once a 3 has happened, we just do the opposite. We take all the bars inside the 3 and we say, this was the previous range. This is the new range. It just got bigger. So that's how we draw them. We draw right to left to include all of those bars. We don't want to draw through bars, right? We want to draw keeping track of all of them. So if we look at the 3 right now, it would look like this, right? 3 outside of these bars. Then this was 3, redraw, outside of all of those bars on the left. And you can see we're right at the top of it now. So the question just is, are they going to stay up there or are they going to start coming back through the range? So basically, if you've ever watched a PMG trade, it moves through the opposite candle color because those traders are not in trouble yet. Yes, that's absolutely correct. So like when we look at XRP, why did this thing launch off so much? It's always because we're going back through a range of guys who are really short the market. It's like boom, 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 cover your short, right? Blown out. And how do we know that's true? It's like, well, let's look at silver. Why is silver going so much higher? Well, if you didn't know, the central banks have been shorting silver since forever. So they're short silver and it's up here now at 70, 80 bucks. Spot prices are well over 100. They're short from 30 bucks and it's at like 100. What do you think they're doing? They're trying to buy as much silver as possible. There's literally not enough silver in the world for them to get out of their short position. That's why silver is going up so much, paired with, demand and all that stuff. But given we are price action analysts, we cannot bring opinion and bias to the market, because opinion and bias, it doesn't really work. What does work though is levels of reclaim and gauging magnitude. So when we go and look at silver, how would we know silver was going to all-time highs? Well, you're going to see this. And this is an indicator I did release a good while ago, but you'll see the levels of reclaim. So notice we made the new low. Anytime we're back above it, it's rejecting. But anytime the year is green, where's it trying to go? All-time highs. Because if the year is green, we can think of it like, if you get on the highway. If you get on the highway and you're going pedal to the metal, full speed, and you're going towards Florida, if you don't let off the gas pedal, you're going to get to Florida, right? What matters is, how hard are you pushing the gas pedal? Like, are you going full speed? You're going 60 miles an hour, 20 miles an hour, right? That's volatility. How fast is it going to happen? It's like how hard you're pushing the gas pedal. If it's going to happen is, are you pushing on the gas pedal and going forward, or are you going in reverse? So whenever the year is green on silver, what's it doing? It's going forward, right? It's going. The longer and greener this gets, the more evidence we have. So you can see they'll mess around about the opens over and over. And I don't have the patience to sit and wait through this. But you'll see eventually, right? Inside bar actionable signal. This causes movement. Boom. 2-1-2 reversal. We called this out at $24. As a yearly investor, that's pretty good to know about. Anytime it was green above 26.70, it's going to 48. And then anytime it's still green, it's still going. And that matters because, like we showed you in SPX, broadening formations over time will expand because you take all short positions taken in the range and you blow the shorts out like this. So it's like 2008, everyone sold. It gets back above that, everyone's chasing price higher and shorts are getting out, which forces this. And then you'll see, right? As volatility increases over time, the yearly chart in 2008 is what a monthly chart looks like in 2020, which is your compartmentalization, right? Each month is like a yearly move in 2008 in 2020. So you'll see the big broadening range here. All the way up they go. And you'll see how it expands the range to the highs. You'll see this broadening range, although it's not the cleanest one. Here, it expands, boom, to the highs. And then you'll see in 2025, this is how we called the bottom in 2025, resulting in a gain of 22%. Beat the market that year. Right here, 2 down hammer, 2 up reversal at 56.95, broadening expansion 6278. And then right now, this is what we see. You can see it's conflicted. So it's going down on the weekly basis, but it's going up on a daily basis. So we've reclaimed this level, which caused that big move today. And the question is, are they going to be strong enough to take this out, or are we going to roll back over, start going to the other side of this range down in here? And that is our question to start off the year. Personally, I don't know if it's going to make that new high or not. What I do know, though, is if they do, they could still bring them all the way back through, because these guys are willing to sell on a gap down. So if it goes all the way back up, they might still want to sell, right? We'll see if they come back and sell more or not. Yeah, so when you see a scenario 3, I don't want to repeat myself too much, even though that's my whole job is just repeating everything, which I love. But I put a video out the other night, and I would like you to watch that, but I'll quickly should give you an example. So this discusses threes more in depth in the chat on YouTube. I'll also put it in Discord. But once you have a 3, it's just, does it stay out or does it go back through? So if we look at beginning of the week, this is the first outside bar of the week, first presented broadening formation, if we were ICT, that's what we'd call it. You're going to see 3. So this gives us levels of reclaim like this. We reclaim that, it's going to go and take this out, and then it goes further. So you can see what matters is, do you reclaim it? And then does it kick in, right? Do the sellers show up? Which in here, you can see bright red bar, they showed up and then they kept showing up all day. So that's a nice trade. The morning opens here. We have a 3, our broadening formation. So we have our levels of reclaim that look, you know, if we look at the morning, we'll see this. They're objectively sitting right there, which is the beauty in this. We objectively get all of our targets to show up. You see, there's the level of reclaim. This actually isn't from here. But if we look left, there it is. So we change continuity, reclaim the level. That's what we're looking for. And then the first target's there, 6871. So you'll see we hit the target and it shows up. There's your target. So now we're at the top of the 3, aka the broadening formation. Then we look for a signal, boom, times the top of the range. Then you'll see we have a hammer signal, boom, times the bottom of this range. So it's just a matter of using the signals, inside bars, the hammers, shooters, all that fun stuff, the 3s, to time the new low or time the new high. Because like here on the 30, you might be like, there was no signal, Alex. Right here, the rev strat, 3, there's your levels of reclaim right here. Reclaim, the second it goes red here, 6908. You at least have a short position for 10 points. Then it continues. And that was your end of day short. Then you can see end of day, they reclaimed, but they never did anything. Inside bar. What made me want to learn the strat over other strategies? You can't disprove it. So I could go, this is the problem. There's a few problems. The first thing is I've always wanted to have a hedge fund, and I've always wanted to do algorithmic trading with the strat. And in general, algorithmic trading and coding and all that stuff, you know, that's just been my interest since I was, you know, since Tesla IPO'd, I think, or maybe it wasn't IPO specifically. You know, around, yeah, since probably 2014, if I had to put a date on it. So it's been a long while, right? 12 years, because I was interested in Bitcoin and all that stuff when I was really young, like 12 years old. I was reading into all this stuff. But I've always been interested in that. And the problem is I learned every single technical analysis thing you could feasibly learn without paying millions of dollars, right? Support and resistance, patterns, EMAs, SMAs, Bollinger Bands, ICT, right? I tried that for a little bit just to see, you know, is it actually viable? And it's not. Fibonacci, crossovers, momentum trading, gap trading with high volume gap names and playing breakouts. You could name it, supply and demand, everything, right? Tried everything. But it all fell short in the sense that price could go from $100 to 200 and they'd be like, well, we don't know why it did it. Or maybe they'd have to, you know, you scramble and you're like, well, it kind of looked like this, so this happened, and like they don't know. Versus Tesla, we can know for sure. It went red here, 382. This year, the yearly group selling, boom, 67% lower. It closes. The next year opened, it went green here at $118. Boom, 100% gain. The yearly group is buying. Why did Tesla short squeeze? The 1, 3, hammer, 2, rev strat above 2850 caused a short squeeze in Tesla, 700% in 1 year. That's it. Right? And if this year can get moving, maybe we can go broadening expansion, but we'll have to see. Still inside year. Therefore, Tesla's not doing too much. Down 6%. It's not doing much. No. Nope. There's mean reversion. Technically, they have, like, they're correct in what they're saying because price discovery occurs as new highs and new lows, which means if we look at, let me think of like the biggest broadening formation we can see. So if we look at Meta, what mean reversion would say is something like this. price, you know, it's going to go up and then it's kind of like a rubber band where it's going to snap and then come back to the middle. Then it's going to go down and then it's kind of like a rubber band. It's going to snap back into the middle, which is partially true, which is why it can work. And a lot of funds will use mean reversion, but mean reversion is not why price moves. That's like me saying the law of gravity is why my car goes forward. It's like, well, it's why your car sits on the ground, but the gas in the tank is why it's going forward, right? And it has to do with the laws of motion and all that stuff. Price does not move under the laws of what we would say, it does not move under the laws of mean reversion. It moves under the laws of price discovery. And there's only 3 truths to how the price discovery works. And one of them might look something like mean reversion, but it's actually a broadening formation like this. So you can say, well, it's just mean reverting, but in reality, price is just testing both sides of the range. They test the all-time highs, they test the lows. They test the all-time highs, they test some lows. They test the highs, then consolidation. They keep testing the highs. And then they test the lows, and then they test the highs. So if you're mean reverting, you know, this is not going to work out for you. Yeah, so someone said Strat is like price action in the purest form. True. And then they said, you know, every other strategy is based on Strat. Incorrect. Every other strategy that actually works must align with the Strat. And people don't like this because they'll be like, oh, look at, I hit my trade. And then it's like, yeah, look at the boom, 2-2 reversal, full time frame continuity. That's why it worked. And they're like, no. It's because my Fibonacci this and my supply and demand this and my option flow that. It's like, there's something to be said about options flow and, you know, unusual activity and insider trading. You can definitely pick up on that. People have been doing that for a while. But when it comes to price, it is only scenario 1, 2, and 3 across every time frame. That's all price ever will do. So anything outside of the Strat simply makes it more complex. And the Strat is relatively simple, but it still has its complexities to it. So I don't think it makes sense to make it even harder by adding on, you know, Fibonacci and supply and demand and fair value gaps. And like, it just makes it harder because you get down here and you're like, well, my entry model didn't show up, but it reversed here at 97. So we definitely could have tried to buy it. It reversed. Or if we go to the quarter, if we go to a quarterly setup, is there an order block that's causing this to move? No. Right? It just took out a ton of these pivots. So it took out pretty much all these guys. There's no order block. Nothing to do with that. There's no fair value gap. Nothing to do with that. So those are not necessary for price movement. What is necessary? 2 down, hammer, 2 up reversal at 14, 14.2. So 142. When did that occur? That occurred with the year green. They sold last year below this. They bought here. Notice it didn't go 1 penny lower. Or what, did it? Well, it went 50 cents lower and then $240 higher. Then it opened the yearly here and did it again. Then it opened here. It did go higher, but it came back. So hopefully that makes sense. But I guess so swing back around. I chose a Strat because it can quantify what's happening. And most traders are basing their decisions on things they can't actually put into logic. It's like if I woke up and I was like, wow, I'm on the left side of my bed this morning. Must mean it's going to be a nice 85-degree sunny day in the middle of, you know, January, the end of January in Wisconsin. Me waking up on the left side of the bed has nothing to do with the weather. The same way, everything outside of the Strat, it may cause price to move, but it has nothing to do with how price is actually going up or down. It's 100% to do with, are the buyers or sellers more aggressive, and what prices are they willing to pay? It's like the groundhog thing for spring. Yeah. So let me just show you. Let me show you then how this actually works. And we're just going to recap. We might have already discussed this. But I want you guys to just see. They don't realize, or they won't admit they're trading the strat. Well, okay, this is the thing. Traders, if they're not using the strat, they might just be amazing risk managers, right? That's 80% of trading is not blowing up. So if you're really good at risk management, the strat just makes you better, because you can be like, well, I really like to play this accumulation, manipulation, distribution strategy where when it takes out the low, then it forms an EOB, and then we have an SMT with this and blah, blah, blah. What you can do is you can take the charts you like trading, you can go up a few time frames and be like, oh, I like trading an inside day that triggers a 2-2 reversal on a week. It's like, okay. And then you can go and use the strat and trade only that 100 times a day, or however many setups there are, because we can actually quantify what's going on. So like one example, what's his name? ADEX was talking about this. He's talking about the week trading a 3-1-2 up to trigger, so we can copy that list, to trigger a 3-2 on the month or any other time frame. And I'm not sure if there's going to be any results here. Let's see. So let's just say we trigger just a 2 up. So if we go here, SMPL. So we'll see. It's not a 3-1. It's actually 2-1 day. But we have inside bar. So you might look at this and be like, here's my range. Like if you like drawing consolidation boxes or whatnot, this would be the equilibrium if we mark it out properly. If we look at the month, it reversed. Was going down last month. Now it's going up this month. So this would be a consolidation breakout into a monthly uptrend. And into the monthly uptrend, we would have a 3-1-2 week. So if we zoom out, what a 3-1-2 looks like is this. And this is, what do the ICT people call this? A breaker block? Something like that. But in reality, right? RevStrat week, which hits, again, if we zoom in here, you can see the 1 and then RevStrat. Boom. This is level of reclaim. So the level of reclaim paired with a daily buyer that showed up at 1886 creates this, which is 3 on the week to the upside after that level of reclaim / target 1. Then, boom, inside week stuck. Most traders, since they don't look at a weekly chart, they would have got demolished in here. We knew it is inside week, so we'd prefer not to trade it then. Now, if we can break last week's highs with an inside day, we have the day to trigger the week to confirm the RevStrat month. So we have a daily breakout triggering a weekly breakout, causing the monthly reversal to keep going. And we are still inside year, so we'd be aware of that. But we can see, we can line up our breakouts and our reversals however we want. So if you want to line up broadening formations and look for those breakouts, we can do that too. So if we look for outside bars, here's all your 1-3s. We'll do the highest ATR, ASTS. This is a good one from today, from our nightly vid. Destroyed 3. So if we look here, all-time highs, all-time highs, all-time highs. This is the previous all-time highs on the month. But we can see this 3 from the levels of reclaim on the mother bar. That's what caused it. You'll see down they went, which creates the broadening formation. So if your favorite thing is to see the broadening formation with a signal that forms down here, back to the upside, maybe this one sets that up for you, right? And if we want to, we can look for 3-2 down and green, Netflix, Kraft Heinz. There's not much else. So there's not many setups here today, but we'll see. Netflix was gapping. So look at Netflix, the gap down buy. You can see the inside 60 here caused it to rally into end of day. That's pretty good. Now the week is going down, the month's going down, but we hit the quarterly pivot target, which is the 3, 1, 2 quarter magnitude. So our inside signal caused this to drop 28%. And yes, the signal is always responsible for price movement. Once it's hit its target, it is exhaustion risk. They might be done selling Netflix, at least for the time being. During today's trading, anytime it was above 82, there was no seller in sight, and that was all day. So the sellers in here got countered. Tomorrow, if we go reversal, look at this. Everyone's short, everyone's short. If we reverse, those shorts are gonna have to cover. We got pivot machine gun. So you can pair a daily reversal with pivot machine gun from exhaustion risk, last year's lows. And looking at the yearly chart, it could get worse. So if this does not work, we could also short it down. So we're willing to go both ways. The yearly seller's more aggressive. So what if we go to like 5? And notice we're looking at every time frame. 5, reversal on the year. It's going up this quarter, it's going up this month. Slight lower low on the week, but it's a 3. There's your broadening formation. So 3-2-2 day, so broadening formation rejection day, to cause rejection of the low of the broadening formation on the week. So you get trigger, target, target. There it is. Now, does that mean it has to trigger? No. Maybe it goes reversal down on the 60 tomorrow. Short-term exhaustion risk, and then the other way. This fair value gap has nothing to do with it. It's this level. Does that level get reclaimed? Because if it doesn't, they're just going to get demolished. Netflix, if you get the chance. I did check it, so hopefully we got that for you. Riot. Yeah, throw them in the chat. We'll take a look. So Riot, the inside bar signal down, right? If we look at the quarter and the year, so this is why multiple time frame analysis is so key. You may say, Alex, it's an inside year. It doesn't matter. It does though. Because we're inside year, it's a consolidation, which means the high and low of this is the consolidation range. And what do we know about consolidations? Right? Consolidations look something like this, right? You get stuck in the middle, and then you make the new highs, and then you do nothing. Then you make the new lows, and then you do nothing, right? Then you make the new highs, and you're doing nothing, right? So whenever at new lows during consolidation, we expect it to go the other way. Whenever we're at new highs during consolidation, we would expect it to go the other way. So when we look at Riot on the year, obviously the buyer's more aggressive. So noted, they did buy it the first month of the year with a signal. And now the inside day down, it's already hit target. So we have no magnitude at this point besides the bullish monthly target. But right now we are inside week. So we're consolidating this year, this quarter, this week. And then this month is trending up. Today was trending down. So this is a mess, right? And this is why consolidation is no bueno. Because it's going nowhere, it's going up, it's going down, it's going nowhere, all at the same time. So that is, that's trouble. So what we would say, this inside week increases the odds that this daily signal, doesn't do anything extra. Maybe it goes down further if Bitcoin gets killed. But this inside week, given the date, it's Wednesday, we'd prefer to just wait till next week. Let that be a 1. Because once the 1 closes, we can look for the 3 afterwards, like here. We can look for the 1 to hit its target and then go rev strat, right? But during a 1, there's nothing we can do. There's no new price discovery happening. It's just going sideways. Are you happy about the Monday, Wednesday DTE on more tickers? I mean, yeah. Who doesn't like shorter dated options? I was trying to buy those SPX 0DTE puts this morning, right at the highs here. I was trying to grab the 6,800 puts at like $1.25. I think by the time it got down there, they were like 8. They could have even been 10 based on how fast it was moving. I stopped looking. But 0DTEs and short dated options, when you know the strat and you know where things are like, go instantly. If you know where it's going to go instantly, huge, huge. A good crypto wallet here. So I got it right here. It's Ledger. Let me make sure. Yeah, I don't want to show anything that I don't know. Ledger Nano. This is what I have. Ledger Nano S Plus. And it's a physical one because if you don't own it, you don't own it. The same way, you know, silver and gold. If you own SLV or GLD, you're never going to get the gold or silver. That's for sure. And just give me a minute. Throw your questions or anything you want to look at in the chat. I'll be right back. Oh, sorry, I had my mic muted. Sorry. My bad, guys. I do that from time to time. But you can see red across all these big time frames. So we'd prefer the downside. We don't want to really buy this. The stuff we want to buy looks like APLD, right? It's actually going up this month. We'll have to see if that continues, right? But it is going up this month. So if we go to hood, we don't really want to buy this unless we could get a rev strat some here on the month. We have about 8 days left. But when you look at it, this year they're selling, this quarter, this month. Since the first month, first quarter, you know, open of the year are all the same, technically we only have the yearly seller present. But we have a monthly signal. The week is trending down this week. And then we have a daily shooter signal. So we have the daily signal to confirm the monthly signal down with a target on the month. And then we have the quarterly signal where if the monthly signal hits target, it triggers the quarter. So you got the shooter day to confirm the month to trigger the quarter with all time frames red, if that works. Now, if we go to VLO, yeah, let's take a look. 3-2. Remember how we said broad informations expand? This is something we look for. The strongest names this year look like this because they rejected, you can see level of reclaim in here. Boom, 3. The buyer came back this year at 163. It's already up 18%. And everyone is so against this, but it's just how it works, okay? If something's going up 100% this year, it has to go 18% first. If it's going 200%, it has to go 100% first. So we want to get the things that are going up, because if you find something and the buyer just cannot buy enough of it, that's the trade you want, right? You want the trade where it's like the whole world is trying to buy this stock and there's just there's not enough. They just have to, the prices have to keep going up. And that you want them to buy aggressively, which is why we look at the gaps and the news and all that stuff, because the news comes out, something really good happens and everyone's like, get me in, right? Like Nvidia last year mostly the year before, but last year too. So VLO, they're really going this year. They have the reversal on the month. It only lasts another 8 days. We do have an inside week signal, but you can see the level of reclaim. We're coming back in. So when we look at this, we have a shooter day signal, which would counter the year, counter the month, and try to cause a rev strat week. And this is why each day, each 60 matters, each week matters. Because if this day breaks and it's successful, the week would flip red and we might go outside bar to the downside and drop 5%. Now, if they did that, we could buy it back up as a level of reclaim in the direction of the year. So what we like to say is, you could short this if you'd like, but I'd prefer to just wait and try and buy it down here. Now you can short it, make some money on the downside, and then when you go long, risk all that money as your stop loss. So if you buy it and you risk like 60 cents, $1, if you made $500 on the way down, if you're risking $1 a share, you can buy 500 shares and you're not risking any of your own money. You're just risking what you already took. And that's the key. If you make a little bit of money, the goal is keep the stops tight enough where you can risk that money and just start building from there. Instead of go in, buy at $100, sell half at 102, sell 75% at 103, and then it goes to $200 and you have 3 shares. We don't want to do that. We want to buy, get more, get more, get more, get more until it's reversed, ideally. Outside year. Well, could it go outside year? Maybe. Is a daily signal that lasts one trading day going to drop VLO 13% in one trading day? Unlikely. We don't even have a magnitude to do that. For us to drop 13%, we'd have to have a target. At this point, we have a target of 6%, so it'd still be up 6% on the year, even if we went outside week. And that's worst case scenario for the buyers. So we're nowhere near changing that. So if we're nowhere near changing that, the yearly buyer is still here, because we'd have to change that to get rid of them. Bottom of the hour is more important, because news events tend to come out at the bottom of the hour, even the unplanned ones. Funny enough, a lot of them will drop at the bottom of the hour. Preferred execution of the strat. It's always the same, but there's a few different places you can enter. So if we know the market is always going 3, right? This is all it's doing. When we have targets, this is all it's doing. You can be the guy timing the signal. So if this is like a daily chart, you could be the guy on the 5-minute buying low of day to change the daily open. That's a lot trickier. It takes a lot more skills, right? You could be the guy buying when it goes green. Maybe it's like a 30-minute reversal. This is much easier, buying when it goes 30-minute reversal. Or you could be the guy, you wait, right? It goes nice and green here. And we'll say, right, during this bar, if it was live and trading, it might look like this. So you're just wait. Okay, the buyer's here. Stop some guys out. It's still green. You get a new 30-minute signal. You buy the 30 signal, and then you're in. Then they do some profit taking, a new signal forms, and then you get in. Then your target's hit. If it closes here, you can stay in, and you're in. So you don't have to be the first guy in. You can buy it here, or here, or here. You just don't want to buy it above this. It's just less, it's more risky because you don't have a target once it's already taken this out. So when we look at like Apple, the plan of action is always the same. And we're going to go here. I just want to show you what the best trade looks like. And we're going to show you a few in a row. So the green solid level is the level of reclaim. This is how we gauge the magnitude. So you'll see it changes color. We don't have to be that guy. You can see it initially goes a little green. We also don't have to be that guy. We just have to know once the setup breaks, here it is, reversal on the month. All right. They've already bought it up 15%. If it's going to go 40%, it's got to go 15% first. Anytime the month is green, it has to be going to all-time highs at 175 and then up here, 183. Anytime the month is green, it has to be doing that. And if we pair that with a pivot machine gun, it should do that faster. And you can see, comes back, then it goes green. This is where you can also be buying it. Anytime it's green. Some slight red, anytime it's green, right? Slight red, anytime it's green, and then targets hit, all-time highs. Every winning trade will look like that. So if we go to Apple, we go to the best entries, it's always going to look the same. New lows, anytime the month is green. Doesn't matter, right? It might take 10 months, it might take 1 month. Anytime it's green, that's what's trying to happen. And a way to see this, if you want to get the continuity indicators, we can use the year, the quarter, and the month. If we go to like a weekly basis, this will give you the levels where it shows you anytime that's green. So you can see anytime they are all green together, it is for certain going higher on a quarterly, monthly, yearly basis. Look at this. This is your trade. Then it changes here. That's when you get out. If you're a short guy, right? The only thing that's different, or that's going to be trickier, is when volatility increases, you have to lower the time frames. So if we're looking at the quarter, the year, the month, Apple, it moved 15% in 1 week. That is like a whole month of trading the previous month, right? So these 4 weeks, in 1 week, we take all those guys out. So each week is like a month. So the monthly chart would become like our yearly chart, right? But each week is like a month. So if we turn it to the weekly, if we go to a daily basis, if each week is like a month, this is the reclaim. Anytime the week is green, it's trying to go there. So you can see each week you can make a month's worth of trades, 15%, 11%, right? The biggest trades, 11%. And if you stop out, so be it, right? You just have to get it here and then hold, ideally. Or maybe you get it up in here somewhere and hold. You buy it here, it doesn't work, so be it. Get it here, hold. There's a nice one. Apple today, sure. We're going to do multiple time frames. This year, the yearly seller's more aggressive. This quarter, they're more aggressive to the downside. Your shooter month caused price movement below 266.95. To trigger the shooter month, you had the outside shooter actionable signal 132, which is something we call a 2-bar rev strat. We haven't discussed here. 132 signal target, right? With the level of reclaim. So here, 1, 3, it was reclaiming the inside bar, not the mother bar. 2, that causes the monthly reversal with everyone selling. The 3-2 shooter day caused the weekly reversal. The inside day 3-1-2 confirmed all those signals, dropping 5%. Today was a scenario 1 for the additional actionable signal for Thursday's trading. So for tomorrow, we'll have the inside day. And this inside day, either, right, we're going to go rev strat of the inside day as a 1-bar rev strat, or we're going to break out of it, you know, to the downside or to the upside. So that's what's happening tomorrow. So what we do is we mark out those levels, and these are our key levels for tomorrow. Any chance for an A to Z epic poem level of reclaim video? I mean, we could. What I'm having our guys do, I gave them the indicator, and this is what I'm going to have them scanning for. So since we know this is true about price, right? When continuity aligns, we have full evidence to know where price is trying to go. We can do the really big trades, right? I'm going to show you some really big ones for your investment accounts. So this is the last thing we'll do since we've been live for so long here. But here's an example. Notice the buyer shows up here. This is a monthly. The target is 24. It's trading at $3. So anytime the month is green, that's what's happening. They're trying to go to 24. There it is, 24. And you can see, you don't have to be the guy at $3. Once it gets to 12, when it's green, we have so much evidence for 24. It explodes. Look at this. We zoom up and left. Explodes. You don't have to get it at 3. It's the slowest down here. It's the fastest once everyone starts chasing price and we start trapping shorts. But so we're going to be scanning for that type of stuff. So another example would be defense. Here it is on defense. Here's your all-time highs. Reclaim. Where's it going? Well, if we have full time frame continuity where all time frames align, and we're going to remove those intraday, we're just week, month, quarter, year. If all of these are green, where does it have to go? And this is a real question. I just want to make sure you guys are following. Yeah, Chuck, I will look at your DM. I apologize. And since we don't have latency, so I just need one person. Tell me where this chart's going to go next. See if you guys have been paying attention. Beautiful. 72, right? Right up in here. Because here's your broadening formation, right? This big range, and we're reclaiming there. Now you could say, right, we reclaimed here, yes. But those smaller reclaims are causing this. Now, how is price going to move? The signals are responsible solely for price movement. So 3, 2 down, hammer, for sure. Now, if we go to SPY, we can increase the evidence by having a hammer on SPY, and we can increase the evidence by having a hammer on Qs with the same level of reclaim like this. We can increase the evidence by having a hammer on the Dow Jones, which the defense sector is a big part of. We can increase the evidence by having a hammer on IWM. We can increase the evidence by also having a hammer on Qs. We can also increase it by having a hammer in tech. We can increase it by looking at discretionaries with a hammer. So do you notice the whole market is telling us, screaming at us, we're about to go the other way, the whole market. So if we know that at the time of this break, it should just go. They're buying the whole market. And 70% of volume is algorithmic trading. So the algorithms are going to be told to buy, take the offer, and do it this month. Boom. And now you're in, right? If you have it at 32, you don't have to get out. And at this point, anytime the month is green, boom, there's your target. And then you'll see exhaustion risk, profit taking. And then you'll see they reclaim, 2-2 reversal, boom, back to the highs. So this buyer, they buy, take some profit, and then they go and they start buying more. And it's all due to the reclaim. So if we go to things like OIH on a yearly basis, sadly, I might have to edit this indicator here. Let's see. If we just go to a quarterly basis, we'll probably see it. Yeah. So if we go on the quarter, OIH, where is OIH going? If it's above all the opens, where's it going? 400% higher. Now, do we have to buy it here? Technically, no, right? You could wait until it's like 600 and then start hitting it. But that's what OIH is trying to do. What about XOP? Where's that trying to go, XOP? Well, if it's above its yearly open, 166% higher. And you'll see the price discovery. Boom, 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 boom. Right? So these are things actionable for this year. The strongest one is Energy's XLE because the reclaim occurred in 2020 here above $19 going to 50. So the XLE is technically stronger than the rest because anyone short in XLE, this whole range, if we get above that, the shorts have to exit. The same way all the central banks are exiting their silver shorts. Same way they're also exiting their gold shorts. There are more short silver, but same thing. So if we zoom it out and we look at like a weekly on gold, it's the same idea. Reclaim level occurred here. 157. Above this is the breakout of all that stuff. The shorts are getting demolished, right? Which is pretty neat. And if we just look at the yearly, quarterly, monthly, those institutional buyers in gold, it's extremely clear what was going on. Definitively. And this is all real time. It plots in real time. So if we go back and we just look at what it was plotting, it starts plotting in real time when this is happening. So it's not a guess. So these indicators, it's magnitude reclaim. So if you go here, magnitude of price discovery, that's what it's called here. The time frame continuity one, this is called TFO. Time frame continuity by TFO. And you have to simply turn on the highlight of TFC up and TFC down. You can also highlight neutral if you'd like, which will show you corrective activity. I just keep it off. And with these two indicators, you have everything besides the signals. And the signals are inside bars, right? Because they signal rev strats and reversals and continuations. 2-2 reversals. 3-2 reversals. 3-2 rev strats. 2-2 reversal rev strats. The pivot machine gun increases our odds of speed. And then we have momentum hammer, momentum shooter, as well as inside bar momentum and inside bar momentum. So if we can align the signals to time our entries, using continuity to know for certain if the market is going up or down, and then broadening formations to time our magnitudes, we have everything. You have the way to time the signal with this inside bar here on gold, which causes the continuity to change green. The 3-2 continuation on gold, which causes this continuity to go green. The inside bar signal to keep buying more. This was a 3, so it was a little trickier. And then this was inside month consolidation, so this is a mess. The 3-2 signal to cause movement. The momentum hammer here to cause movement. 3 reversal. And you'll see the inside signal, which they gap, so they get messed up in here. 2 down, 2 up reversal. 2-2-2 continuation, reversal down, 2-2 reversal back up, keeps going. So using reversals, we can get in. Using continuity and levels of reclaim, we can gauge magnitude. Where's it going? And is it going there? Because it's only trying to take your targets when you have all time frames aligning. When they're not all aligned, it is not attempting to take that out. It's trying to take something else that's closer out. Yeah, so if you're looking at futures, we prefer the bottom of the hour, the 9:30, 10:30, 11:30. However, you can time that with the 30-minute, which is why we use the 30 and the 60. Because the 30 is the top of the hour, the 60 is the bottom when we're timing RTH session, 60 minutes with no extended hours. But when you're on the futures, the 30-minute will time the top and bottom of the hour, and the 60-minute times only the top of the hour. So it works the same way. It's just you have to understand when 9:30 is, 10:30, 11:30, because those just tend to be more important. And that's just been true for a while. So you can see 8:30 right here changes what's going on. 9:30 right here keeps confirming. 10:30 right here keeps going. 11:30 sell. 12:30 consolidation. 13:30 anytime we're above that, boom. 14:30 goes all the way up into exhaustion risk, which you can see if we look left, right there. And they'll say, oh, this is a fair value gap. What matters is not the gap, right? What matters is this high, the top of the gap, because this is the level of reclaim. So if it's reclaimed, then that's bearish. If it's not, it's not bearish at all. So when this 30 goes red, it's attempting to reclaim that, which it did. And then consolidation. Strat stop loss does not work well with futures. False. The simultaneous 60-minute break works the same on futures as indexes. And the way it works is this. Sadly, one thing you can do actually is you can go settings and what? That might be why. Instead of messing with this, let me just try one more time. It's because it's not a future. That's why. So we go regular trading hours. Works the exact same. The best signals when we have full time frame continuity will go instantaneously. And that's relative to the time frame. This inside 30 signal had a total drawdown of 1/4 of a point on ES. Therefore, our stop loss worked and you made all this money this morning. If we're trading the morning open, since the volatility increases at the open, we do lower the time frames. You'll see they go consolidation. We do not trade this. Test the highs, test the lows. The reversal here, no drawdown. Inside signal here, no drawdown. Signal here, no drawdown. Up they go. Rev strat right here, no drawdown. Maybe a 1/4 of a point. Broadening formation retest. Signal here, no drawdown. Goes up. Does back test, so maybe it stops you out. Signal here, no drawdown. And this is a 1 minute. If we go to a 5-minute basis, this 5-minute signal had no drawdown. 2-point stop. This signal had no drawdown. Goes 10 points with a 1-point stop. Now this signal did have drawdown. Might have stopped you out. That's fine. Momentum hammer here. At worst, your stop's 2 points. And that goes 30 points. Right? Hopefully you're seeing what I'm seeing. The 3-2 reversal. This is the one with no drawdown on the 5-minute. Now, with the simultaneous break, we do not require that it goes instantly. So when we look at ES and NQ, notice both of them inside. The Dow Jones, inside. The IWM was actually, RTY. The IWM inside. So what does this tell us? Well, glad you asked. This is the last thing we're going to cover. I know we've said that once, but here it is. And this is the key. If you are struggling, this is the key. A simultaneous break is when we have multiple correlated assets breaking a 2 in the same direction at the same time. We can identify simultaneous breaks by index, SPY, Qs, Dow Jones, IWM, by sector, technology sector, communication sector, discretionary, retail, blah, 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 right? And by the holdings. So we can look at all of the S&P holdings, all of the IWM holdings, all of the Dow Jones holdings. We can do that too. What a simultaneous break tells us. When a simultaneous break occurs, all 2s in the same direction, it tells us of algorithmic activity, meaning algorithmic trading. This means a simultaneous break is the most definitive buy or sell signal we have. Given the power of these signals, we look for it on the 4 major time frames, the 60, day, week, and month, as well as the quarter and year. So what does this tell us, this inside 60? Stuff's about to go down, right? We know that. For this whole entire 60 minutes, you should be just like, oh yeah, this would be good, right? This is going to get moving, okay? Especially when the VIX is high, right? If the VIX is like 40, 50, 60 points, this can cause things to just explode. Now, how do we trade the simultaneous break? Given the high amount of evidence, when the break occurs to the upside, we widen our stop like this. So in the highest amount of evidence, we have the widest stop. It's kind of like if you're a card counter, and I really love this analogy because it's similar, but our edge is actually way better. So if you ever tried counting cards, this is way easier, way better. But if you know, like if you're playing blackjack and you know you're about to get blackjack, which if you don't know, it's the best hand. You get paid out, you win, casino loses. If you know you're about to get blackjack before the cards come out, what are you going to do? You put all your chips, like you don't just put $500 out, you put 6 hands of $500 out, right? Like you put as much money on the table as possible. So when this happens, that's what we do. if RTY breaks, we buy it, our stop goes here. That's entry number 1. We're not just doing one of these, we're doing all of them. So if we go to the ES, when this breaks here, our entry is this, our stop is this, right? We have initial target of high day. So you might say like, well, this is 1-to-1, Alex. Risk reward is completely irrelevant because if it doesn't reverse, it doesn't reverse, right? It goes 78 points at the high. And if you held to the close, right, maybe you're up 45 points. What matters is evidence, because you can have a coin flip 50-50, but if it's, you know, you win 10 on one side, you lose 10 on the other. But if that coin lands on heads 70% of the time or 80% of the time, you should be playing the 50-50 bet, because 80% of the time you're going to double your money. So if 80% of the time this will double our money, we should buy the Russell, and then we'll buy the ES. And then we're also going to buy the NASDAQ right there, right? That's a good one. 400 points at the highs. We're also going to buy the Dow Jones right there. That's a pretty good one. 500 points. We're going to buy all of them because each one that breaks doubles the amount of evidence we had before. So if we had one signal that broke the inside bar, that's one signal. So maybe we go like a smaller size on that one. The second signal to break, double the previous size. So if we had 1 share on the first one, we buy 2 shares on the next signal. The third signal, maybe we 10x. Now we buy 20 shares here. The fifth signal, right, if we keep going, 100 shares. We'll get 100 shares on this one. And, you know, technically, the later signals that break have more evidence, but they're weaker. But when the whole market breaks, the whole market's going in one direction. Right? It's like, it didn't matter if you bought the IWM, the Qs, the SPY, or the Dow Jones today. What mattered is, did you buy it? Because they all reversed on the 60 at the same time. And not only can we see this in hindsight, but in real time, we can see the breaks that occurred. If we go into, you know, any of these sectors here, we'll see that. So let's go to technologies. So you'll see, and I just want to make sure we're correct here. So this was 1230. So notice 1230, we opened with 72% inside bars. How many are trending up and how many are trending down? And this is like the coolest stuff. I wish it fit the screen a little better. Let me, I'm not even gonna mess with it. Maybe I can. There it is. I wish I could drag it to be full screen, but I guess if we zoom out like this, the green line shows the amount of uptrends in the technology sector. The red line shows the amount of downtrends. The yellow line shows your consolidations. So the yellow line starts high because most things open as a 1, 82%. 930, you can see they're buying. And then it crosses. So what does that mean? There's more uptrends than consolidations, and there's more uptrends than downtrends. So the price was going up. Then 78% go inside. Right here, they cross 1039. There's more downtrends than consolidations. And the downtrends and uptrends crossed here at 1031, right at the open. So the downtrends overtook from 1030 to 1130. And if we go, 1030 to 1130 on tech, and I need to make sure, right? Does the market open at 8:30? It does. Okay. So you can see from 10:30 to 11:30, there was more downtrends going on in tech than there was uptrends at the time of 10:40. So while tech is still going up, or actually right here, let's just get really specific so you can see on a 5-minute. While tech is still going into new high of day, we have more downtrends than uptrends and consolidations in tech. That's an early reversal signal. So what happens right after that? Down they go. How did that happen? Well, 11:30 opens right here. And you'll see right at the open, 28% downtrends, 1% uptrends. So instantly, most things are going down and you have more things consolidating. By 11:47, most trends are down and most down, or gosh, right? So much talking today. But you can see half of them are going down, 2% or 9% of them are going up, half of them are going inside bar. So there's still more downtrends. And then boom, right here, 1249, the uptrends cross over. And then here, you can see right at 1330, boom, they're buying everything. And then 1430, you can see 30% of those start consolidating and 60% of those start going down in tech. So they bought a ton and then they sold off half of the things they bought. If we go to Staples today, it'll look much different. You can see there's a lot of consolidations in Staples today. They started buying more Staples into 1330. And there was, some buying 1030, some buying in here. But what we're really looking for and what we really want to see is when they all align in one direction. So like this, 98% of discretionaries going up at 14, which is 2 p.m. So we go to discretionaries, 98% going up. That's what that looks like. And if we get really specific to it, that occurred at 1427 was when they started really getting after it, right? Notice, was that, 1427. So notice when that happened. That was like way over here. So the buying started happening here at 1234 is when we picked up on that really aggressive buying. And then it was confirmed at 1332. They're still aggressively buying. So if we just plot this on a chart, it'll be 50% two up at 1234. And this is like the coolest indicator. I can't believe more people don't want the scanner. It's just the coolest stuff that's, I think, ever been made. Right here, this is the buy signal. So if we were to overlay these, 1234, so it actually might have been sooner than that. This is 1334. 1234, so here, this is when the buy signal crossover happened. This is when the big move happened. So algorithmic trading showed us exactly what was happening well before. And you'll see, right? The signal itself is not the thing that's bullish. What's bullish is that it continues to stay true. Because Tesla can go from $100 to 150 all day long, but if it's going to 1,000, it has to stay at 150 and then go to 200 and then 300. So does it stay true? That's what matters. And if we go to the things that were weaker today, like financials, into the close, you had 66% of financials going down. So you can see into the close, these guys are getting wrecked. And that crossover happened at 1445. Which, does that give you a lot of time to trade it? No, not really. Right? But it was right here. Right when it went inside, you can see the inside bar. It shows prices weakening. It's consolidating and then reversal. Boom. So this showed you the inside bars started forming and then it broke. Most of them going down. And not only can we look at this on a 60 basis, but we have the daily as well. And you can see like materials today, 81% going up. That's normally a good thing. So materials, 81% going up. Should it close out near the highs? Definitely. And it's probably going to keep going. Because look at what they're doing in materials. When did they start buying it on an investor basis? Right there. 45, now trading 49 on a yearly time frame. What's causing the movement? Hammer year. All year. Does this analyze constituents? What do you mean by that? And percentage, yeah, we can go back to this. Do you mean like specific stocks? Breaking down a whole into its parts. Yeah, so right now, actually, I'd love to show you guys this. You can see me talking with Claude here. But JSX. So this is just a prototype, but this is what we're working on right now. And this one, it just looks so much better, doesn't it? But so what we're working on right now is this, where we can show the amount of uptrends and downtrends. You can see alignment. We can also look at distribution. So it's just a different view of the same data, showing you how many things are going up, how many are going down, how many are going sideways. And then signals, right? Where we have the continuity and the actionable signals in force. And then setups, where all the inside bar equilibriums are at, where all the outside bars are at. We could also have 2 down in green, 2 up in red. So this is kind of the view we're going for. Now what we want to be able to do, like you said, the constituents, we want to be able to dive in and just click tech, look at that and be like, all right, right? Tech across the whole tech sector, each stock specifically, this is what's going on. So, you know, swing traders, investors, we have all the evidence in their favor. You got some setups on the daily. Drill into tech. Here's the specific sectors, right? Then we drill into that. And this way we can go specifically into, you know, the holdings of each subsector, because then what we can do is kind of like today, if we go to those sector stats, 84% of materials. So the scanner automatically highlights materials blue for us because when we're on a daily basis, this is where the most evidence is on the upside. If we go to technology, you'll see it's the most on the downside. It does not highlight. But like materials today, if we know for a certain 84% of materials are going up today, and we know that, when did we know that? We knew that at the open, 62%. So a majority is going up and there's none going down. And we still have 35% inside bars, which could become uptrends. So by the end of the day, you got 12% inside, 81% going up. So right at the open, we already have all the evidence we need to be a buyer of materials. So if we know that, it's for certain going up. All we have to do is look at the strongest ones that have signals that are breaking. So if we look at all these at the end of the day, the strongest ones, we go to a 30 or 60 minute. CE, boom, that's up 6% to start the morning. Does that matter? It does. So we stop some of those guys out. Here's your hammer, get in. Momentum hammer, get more. Momentum hammer, get more. Inside bar, get more. Because we know for sure, right? At the open, we knew for sure they're going up. And then you let this happen. Boom, bright red bar. What's that setting up? Well, all known time frames are green. Therefore, all known participation groups are buying and taking the offer. So this was profit taking. When this breaks, that's a for sure going up, which is why it shows green, you know, in here. But that's a for sure. So if we go and just take a look, the cheat sheet, it's drawn the way it is very specifically because you want exactly this condition. This is the condition we want because we have trap traders, we have a big short position open, and we have a large target. So we got trapped traders down in here, anyone shorting this. Then we got this long red bar, these short positions to trade against, paired up with an institutional yearly buyer here at 46 bucks. Boom. And then if you're good at this, since you know that, every time one of these 5-minute bars goes red, it's giving you additional, you know, potential entries. You get this nice red, it reclaims here. You get this red bar with the inside in green, starts coming back. You get an outside bar here, then the inside bar signal, there we go. Inside bar with the rev strat, get more. So you can literally entry buy. You could have 10 shares down here and 1,000 at high a day. Simply because we know it's for sure going up at that point. Scanner's next level. It really is. Like we're working on making this view better just because I know it's not the most intuitive. Like once you understand it, it's pretty neat because we can turn off things. Like we can just go look at only the uptrends, you know, only uptrends versus inside bars. And, you know, if we go to a 60-minute, you can see like when more things are consolidating, when more things are going up, like this is really neat. So we go to materials. It's like a lot of consolidation, tight stuff. And then here, the buyer shows up here and here, right? So it's pretty neat. But back to this, we want to make it so we can drill down and just have the alerts. Because if we go to signals, let's go all the way back. So if we go to signals, we should be able to have a list where it's like, yep, these are the things they're buying right now. These are the things they're selling right now. And then we should be able to take that list and 5 minutes before the new 60 opens, here's all the sell signals, here's all the buy signals, right? It should be very cut and dry. Right now, it just takes a little bit of head work, but you know, we can't give it, we can't do much better than that. What source do you use for data? we are 3 doors down from the New York Stock Exchange. So at least that's where our data provider's hooked up. And therefore the data is extremely expensive. It's tens of thousands of dollars a month, because this is all live tick data streamed and as real time as we can really get it into the scanner. Have you automated to trade algorithmically according to all these rules? Not quite yet, but we're so close. Like I was literally saying a prayer the other night. I was like, I know we're so close. Like I just need help getting this last like 10% here. And the thing that's gonna do it is this. Give me 1 sec. All right, sorry about that, guys. But bread and butter is really just being able to gauge magnitude, because then you can add to positions. So kind of like this, right? Understanding if we're above that, every red bar is corrective against these time frames. Every signal is a way to add more. Buy. And then at the highs here, once we get up there, reduce. If you reduce half, you can put your stop down here. And you can just leave it, because at that point you're good. Or you can hold the whole thing with a break-even stop. But that's what the algorithm's going to do. We're working on it. I'm trying to give you guys the tools. My developer hates me because I share what we're working on. So, you know, if you go to TradingView, you just type in Alex's options TradingView. You go right here. You'll see some of my ideas from, you know, back in the day when I first started trading. And you'll see it's a lot different than what it looks like now. Look at this, right? Like all the Fibonacci's and bullshit. Gosh, right? I wasn't lying when I said I've tried everything. But if we go to scripts, magnitude of price discovery, time frame continuity bars. quantifiable broadening formations. These are the three things I would say to take a look at if you're going to use any scripts. In reality, you don't need them, but this is what I'm using to build into our algorithm. These two more specifically, as far as gauging magnitude and knowing when it's going to happen. Very, very important. But that's all I've got for you guys today. So, thanks for hanging out. And if you're watching the replay, check us out, stratalerts.ai. We are live 5 days a week, sometimes, 6 or 7 days a week, depending on the week. But go check us out. You can start for free. Just give us your first name, your email, and we send a ton of free stuff, resources, educational stuff, all the works, right? We're never going to share your email, but that's all I've got. Have a good rest of your